What's Making Headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome back to What's Making Headlines. It's Annie, Charlie and Ben with you today, unpacking the news of the week. And what another bumper week. We say this every week, but it is non-stop at the moment. Ben, how was your week?
Yeah, pretty good. Working on some things for September as well at the moment, which is exciting. But heaps of news this week to keep track of as well.
You were constantly writing, I think, in advance because you did a lot of our magazine and commercial content, whereas Charlie, you're kind of doing the day-to-day news. So between the two of you, you've got great oversight of what's trends have been happening, what we've been doing.
Yep.
This week, I think, as we said, always focused on what the lenders are doing, but it has been a huge week for lenders this week. And a lot of our headlines, our most read stories have been about what the banks are doing, what the lenders are doing, and what the non-banks have been doing. First up, like one of the big non-bank stories, I think, came when we broke the news about Liberty Financial joining the lender panel of the 5% deposit scheme, and the first non-bank to officially be joining the scheme.
Yep.
Now, it's pretty exciting for brokers who are wanting to use lenders that have maybe slightly more diverse policies, can do a little bit more tweaking and tailoring.
Yep.
And Liberty, as we say, the first one to officially join. I think the only other non-bank on the panel is the Indigenous Business Australia group, but they're technically a government-funded body, so we don't count them as a non-bank.
Yeah.
But big news. What did you guys think? Exciting.
Interesting. It's potentially exciting for borrowers as well, because being the first non-bank on the scheme, in the sense that it could probably sort of slightly increase the amount of choice they have if they want to access the scheme. And it also maybe potentially sort of creates a pathway for more non-banks to join the scheme as well.
Yes. Well, I do expect we'll see more non-banks come onto panel. Once one comes, seems to be a floodgate of them. But obviously it takes time to go through all the kind of the admin of getting onto the lender panel for the 5% deposit scheme. Charlie, when you were, I think you wrote the story for us on
Monday morning.
Monday, was it? Yes, that's right. And
hot off the press.
Yes, Liberty weren't quite ready for us to announce that, I think. Sorry about that, Liberty.
Slightly beat them to it, but that's okay.
We beat them to it. But that wasn't our fault,
No, we're just prompt.
We're prompt,
Across
exactly. We're prompt. But yes, they eventually released their own statement once they'd kind of, got through the whole process and had their morning coffee. What were they saying?
So, as Ben was just touching on before, they kind of touched on Liberty pertaining primarily to borrowers that fall outside the traditional kind of scope of mainstream banks. And, they said it's a positive thing that a non-bank that, such as Liberty, that specialises in this category is now in the scheme, because, it's bringing in such large numbers of new entrants every month. We got those data from Housing Australia. We'll talk about that a little later. But the amount of new first home buyers that are being drawn into the scheme every month, they stress that it's a positive thing that you've got a non-bank that specialises in kind of alternative credit. So looking forward to servicing those borrowers and their needs, because there's probably many of them that fall outside that traditional scope of mainstream lender policy.
Yeah, and it's such a successful scheme in terms of usage. Like we know, as you sort of said there, like so many first-home buyers use the scheme, and it's no longer limited to middle and low-income earners, as we know from October last year, it was expanded so that anyone who doesn't have a deposit save pretty much can use it, as long as they're buying a property under the property price caps. And some interesting stats came out this week as well from a Senate inquiry, I think it was, from Housing Australia, talking about who's been using the scheme and saying actually a surprising amount of people buying their first home and then flipping it into an investor property not too long afterwards. Of course, you have to live in the property for, I think it's 12 months under the scheme, but you can then change it for different purposes. And looking at the amount of people who'd bought under the 5% deposit scheme, lived in it for a bit, and then turned it into investor property, I think we probably will see an increasing amount of people doing that. But interesting also seeing the types of borrowers who are using it too, because it's not just, as we say, middle to low income earners, anyone who can access the scheme who doesn't have a deposit, doing so, some high income earners.
As caps were, as you said, removed last October, and we're getting these data releases from Housing Australia in response over the last couple of months to questions on notice at some various Senate inquiries that they've appeared at. And it's interesting to see how the scheme's evolving, especially post those income caps and limits being removed, seeing more borrowers that earn more annually than those income limits were set at accessing the scheme. 1 in 3. It's now
First-time
believed,
buyers.
1 in 3 new entrants into the scheme between October when it was uncapped and April. 1 in 3 new entrants are now over those income caps, whether they be single borrowers or dual borrowers. It's usually dual. The overwhelming majority is dual. But yeah, I think it's interesting. But you know, as we talk about before on this podcast, it services first home buyers irregardless of income.
Yeah.
So it just shows that it's getting out there and that the scope is widening, which is only what you expect would happen when you kind of remove caps and whatnot.
Yeah, I haven't actually done a final count recently on how many lenders are now on the panel, but it must be over 20.
Yeah.
Probably over 30.
I think it's over 30. I did a count when I was writing that story on Monday, and I've got in my story that it's well over 30.
Well over.
Well over.
35.
And Housing Australia's
Just guessed.
Housing Australia has called for more lenders to join the panel, so you can only expect we'll probably get more announcements in the coming months.
Yeah.
And hopefully more non-backs too, as we were just saying before.
Yeah, because it's obviously, as we say, like people have different kind of income streams. They have different requirements. They don't always have documentation that some of the mainstream banks might require. So good to see a broad breadth. And it comes, like as we said last week, hot on the heels of the Teachers Mutual Bank joining the Help to Buy panel. So obviously Housing Australia has been finalising, crossing its eyes.
Hustling.
Yeah, crossing its teeth and dotting its I's and getting all these sort of like lenders back on board. So I expect to see more coming up.
Yeah.
But speaking of lenders, there have been lots of movers and shakers as well this week. One of the big stories, again, about an exit from the Australian lending market was HSBC.
Yeah.
Farewell HSBC, because it's selling its home loan book and exiting Australia for mortgages.
Yeah, this was a massive story that we wrote on both The Advisor and Broker Daily last Friday. And it's generated a lot of discussion about what this means for the Australian mortgage market. But yeah, this was a huge sale. So HSBC Group announced that HSBC Bank Australia had agreed to sell its home and personal loan portfolio, which is valued at $36 billion, to Blackstone. And that Pepper Money has been appointed to manage the book upon completion.
This is always really interesting to me when you see a bank book being serviced by a non-bank, because the experience is going to be totally different. Like if you're a bank customer and then you kind of move to a non-bank and you're being serviced by a non-bank, it's going to be a totally different experience. I'm really interested to see that Pepper Money is the one that's going to be managing them.
Yeah. So it's obviously not instantaneous. It's going to take some time. So it's expected to complete in the first half of 2027. So actually not too long, only about a year.
7 months,
yeah, give or take. And it's the largest mortgage transaction ever to eventuate, which is huge.
How much was it? Do we know?
Well, the book is worth $36 billion. So I think on value terms, it's the largest to transfer.
Oh, I see.
Yeah.
In terms of the size of the book.
Yes. Yeah.
But it's not, obviously, as we know, the first time HSBC's kind of stepped in, stepped out.
No.
As is always the case over cycles, people come, people go. But yeah, it's sad, kind of sad to see them go. And we were talking about this earlier today is, well, who does this mean will become the 10th largest bank once HSBC has left the mortgage market? And we think it'll probably be AMP Bank.
I think so.
Yeah.
Because I wrote a story in the middle of the week on those monthly ADI stats.
From
I was having a little peek who's 11 and 12 and 13. And I think AMP Bank is going to fill that slot that's going to be open now that HSBC Bank is departing, which they're in 10th place. And interestingly, well, perhaps not so interestingly, but they did grow their book in June for when those stats covered. The month of June, HSBC Bank grew their residential mortgage book, which I found particularly interesting. But they're also going to wind up their retail bank as well. So they're basically exiting the entire market.
Yeah. And I think this, again, has got a lot of people questioning, well, you know, this will keep brokers busy. Everyone who's got an HSBC client will be looking at making sure that they're aware of the change and being like, this is what's going to happen next steps. It's obviously going to keep those brokers busy. Yeah. But also, I think customers more broadly who are HSBC clients, not just at the on the home loan side, but also on the banking side, which they have a substantial deposit book, are going to be like, where do I go?
Yeah.
So the banks, I imagine, will be pretty busy looking for HSBC clients and be like, well, we can help you.
Yeah. But yeah, FBAA CEO Leo Gajic, he also commented on the story, but he was sort of mentioning this is a really good chance for brokers to sort of engage their clients if they've got a HSBC loan and sort of let them know what's going on and sort of talk
10th
about their
largest
options.
bank in Australia, nothing to be sneezed at there.
No, absolutely not.
By mortgage book. Talking about lenders, the other big one we saw was Macquarie selling off its reverse mortgage portfolio. And again, we kind of knew about this, like similar to the HSBC thing. We know it's been in motion for a while, but actually completing its transaction. Charlie, again, I think you were writing this one.
Yep.
What's the go? Who's bought it?
So it's Household Capital, which is a home equity retirement provider. This was something that I believe Broker Daily reported on a month and a half or so, announcing
when they were talking about it.
Announcing that the acquisition was taking place, and we got official notification that it had completed this week by Household Capital. So all borrowers have now been onboarded to its platform and can now access its suite of retirement funding services, and consolidates a pretty significant slice of home equity release under a specialist non-bank, at a time when you're seeing a lot of kind of institutional investors showing stronger appetite for reverse mortgages. We're seeing that a lot.
And generally, I think across the board, lots of lenders moving into the reverse mortgage and equity release space. We've been talking about this, I think, pretty much every week at the moment. There's some sort of change in the equity release space, whether it's a new player or a new product or a consolidation or some new stats. Household Capital has been all over the shop at the moment. No, wait, let me rephrase that. Household Capital has been everywhere at the moment. I feel like every couple of days we see something from them. They've been busy, so really dominating and bedding down in that reverse mortgage space.
Yeah, one of the things they were saying in the story too is they sort of estimate the sort of retirement wealth market for the sort of customers they're targeting to be about $3 trillion in residential property wealth. So they're obviously sort of seeing that and seeing a lot of people who sort of fall into that profile will be coming to the stages where they do need to sort of release their equity in their property.
I wrote an article
kind of
a couple of months ago about how large the kind of pool of untapped equity release actually is. I mean, you've got the market that you can access in terms of home values and what that's worth, but then the amount of people that are actually taking advantage of that is still,
if it is appropriate to them.
Yes. Good point. Is still kind of comparatively quite low, but
because the market's about $12 trillion, so we know kind of it's about a quarter, basically $3 trillion is the sort of market that Household Capital's looking at in terms of saying that could be who's using this and who could be qualifying for it. I just thought that was pretty interesting. And the other completion of sale is again Westpac completing the sale of the RAMS mortgage book. Pretty interesting again, and again something we've been writing about over the last few years actually is the RAMS changes and what's happening there. So completing that sale, and again, I think nothing major in it, but always a good opportunity for broker clients to make sure their clients are aware if they've got a RAMS loan. Yeah,
100%. This was I wrote this story, and it transferred at $15.4 billion the RAMS mortgage portfolio, which was down from 21.4 when Westpac signed the binding agreement in early November last year with the consortium. So it's comprising Pepper money and credit
busy,
funds.
aren't they?
Yeah, very much so. So that's another portfolio that's now going to be managed by Pepper. So they've got a lot on their hands, but very active. Certainly in the last week as well. So a lot happening in the mortgage market in terms of acquisitions and sales and that kind of thing.
Well, if you missed some of those stories, I do make sure you check them out in the show notes. We'll leave all the stories linked that you can read up on if you missed some of those acquisitions and purchases. But we'll take a quick break here. When we come back, we'll be looking at what's happening in mortgage demand, what's happening at the lenders, and we'll get into it just after this. So we know the last few months we've been seeing mortgage demand softening, particularly when it comes to investor market. I mean, anecdotally, we've been talking to the aggregators and seeing a huge dip over June, July following the budget changes when the negative gearing and CGT changes were announced. And since then, obviously, the SMSF LRBA ban as well coming into effect next week. So lots of people looking at, well, what's happening in the market? What does it mean for borrowers? Where are they going? What are they doing? And we get, as slowly the data comes out, looking at what is happening, knowing that mortgage demand is really dropping and quite quickly, what do you guys think about this sort of story that we wrote about this week?
Yeah, I thought it was quite interesting to sort of see how through the data you could see sort of two very different periods, sort of that April to June period sort of showing where there was a bit of a drop-off based on that sort of regulatory shift we're seeing. As was sort of saying, cash rate increases and tax changes that we sort of talk about has sort of really reversed that picture quite sharply in terms of mortgage demand, with demand being 12.5% lower on the year, which is, super interesting. Yeah, and I guess probably what you did assume to happen as well. But yeah, it's just interesting to see the numbers reflect that too.
It swung in quite a short amount of time as well, because
Quickly,
in the months prior to the budget changes, earlier on in the year, in April to June period, it was up. Mortgage demand was up 3.2% on the year earlier. And now, post reform period on Q2, it's dropped 15%. So it's turned around in quite a rapid amount of time. So it just shows how much impact both, obviously, the successive rate rises have had on cooling demand and getting people to, causing people to pull back and kind of see what's going to happen with rates, but also the ambiguity and also just the cooling in, I think, appetite and waiting for the dust to settle post the tax reforms as well. They've really landed at almost the exact same time, which Equifax stressed when they released this data. It's no one factor is kind of outcompeting the other. They're working hand in hand.
Yeah. 2 points that you thought were interesting. So the first one was around the decline, but I think the second one is really also about the increase in hardship requests.
It's basically worked in tandem, I guess, as kind of mortgage demand has decreased, so has hardship requests. And this was evident in the Equifax release that we got this week. So they vary by product, but hardship requests on cases with mortgages are up 5.3%, and non-mortgage hardship increased by 5.6%. So it's pretty even there. Credit cards are the most resilient. They're at 0.14%, hardship rate of 0.14%, but personal loans hardship request is up to at 1.10%, and this is on Q2 this year. And auto loans is up marginally as well. But Victoria has become this kind of hotspot, quote unquote, according to Equifax, for financial stress, and both mortgage specific and total hardship rates across the states. But Equifax has also said people applying for hardship earlier has also increased. So people are being like proactive and trying to get on top of potentially missed repayments and trying to curb that, nip that in the bud.
I think a lot of people now are also better versed in it because of COVID. So like when we went through the COVID pandemic and, a lot of people had to do repayment holidays, I think that became a much more broad conversation. People realized you could ask for a repayment holiday and you could ask for assistance. And the banks have been a lot better, and the lenders more broadly have been a lot better at actually talking about hardship, because of course they don't want people to go into repossession. So they're like, what can we do to get you over this like trying time while you kind of figure out what you're doing? So I think there's a lot more awareness of hardship assistance, which is good to see. And obviously, as we sort of hopefully only see a marginal increase in the number of percentage of people who are requiring hardship. But still, looking at the lender data that we get coming through, we're just about to start the next lot of financial results. Yeah, so starting to see some of them come through. We had AMP, I think, this week for half-year results, and REA Group for full-year results. But yeah, looking at whenever we talk about the results season and go through the investor packs for the lenders, looking at, well, what is hardship doing? And it's still pretty low. Like generally, mostly at most banks under 1%, or some cases under 2%, but much, much lower than it was before the pandemic. So it's good to see that it's still relatively low, even though, as we said there, Equifax data showing us that it is climbing.
Yeah, and they did stress not to make too much of that, because they noted that people are really getting ahead of it and applying before the situation I don't know, disastrous. They're getting in front of it. So just because you're applying for hardship doesn't mean they're necessarily in hardship at the moment, which is what they said. But I wrote a story a couple of weeks ago on Experian data about showing the outcomes of borrowers that apply for hardship earlier on is obviously, but it's far greater than those that kind of stumble into it.
Yeah. And so again, if you're a broker and listen to this and thinking, I haven't talked to my clients in a while, might be worth reaching out, making sure they're all okay.
Yep.
Seeing that, they are aware if they do need support, the support is available, and of course offering it to your clients. The other big thing we saw this week was some more detail around what's actually happening with the tax changes for investors, and this has been something that's been going on since the announcement in May. But finally, a new consultation on the final kind of updates of what's happening in the negative gearing.
Hopefully, what's the final?
Fingers crossed. You're right. Actually, it's still going through. It's a consultation at the moment, so it might change. But looking at the detail of how they're going to be changing some of the carve outs for the negative gearing and CGT changes. The big one, I think, probably being widow tax.
Yes, basically, Treasury sort of confirmed that they would be sort of removing that unintended tax consequence that a lot of people were sort of worried about, where widows or divorcees who inherit their partner's share in a sort of jointly owned investment property, they'd be allowed to retain those sort of grandfathered tax settings.
Negative gearing, because that was a bit of a penalty, wasn't it? They were saying, well, if you kind of have a relationship breakdown or you're widowed, it shouldn't be that you're then clobbered with having to change your whole investment strategy because your partner died. So saying, well, there is then this carve out, they can still continue to negatively gear even though the title might change.
That's been removed.
Yeah.
In the explanatory memorandums that were released in accompanying these tranche 2 draft exposures. But it's a politically sensitive issue for the government because obviously you had independent Senator David Pocock advance his own amendment only hours before the budget bill passed in both houses of parliament about a month ago. And the government obviously pledged that they were going to fix this issue. And they have.
And they are now.
And they have. But, the Senate really wants to go on this ASAP. Even
Oh, good.
Yeah, 100%. 100% as well. And you've also got the draft changes dealing with the issue of like more complex ownership structures as well, which I found interesting. So like spouses in some households aren't listed on titles or treated as tenants rather than explicit co-owners, but then in this tranche 2 material it made clear that these spouses will still be protected so long as they like generally acquire the property through death or like relationship breakdown as well. So that's still going to be upheld.
So even if they're not on title?
Yep. If they have genuine claim and kind of documentation to prove that, then that'll be factored in as well. But there was also the expansion of the definition of like new dwellings.
Thank goodness.
And new build. So originally, a property was considered new if it had been unoccupied for less than 12 months after certificate of occupancy was issued before being sold. But there was a lot of protest about this, especially from the construction industry. And the draft changes have now explained this is going to be expanded to 24 months of a certificate of occupancy being issued and extends it obviously by a year. And it did explicitly state that this would kind of better alleviate, this alleviates and addresses builder concerns and developer concerns.
And it broadens out the amount of properties that you can actually negatively gear because that is a lot of properties.
Yeah. And there's also negative gearing exemptions for NDIS specialty disability accommodation, affordable housing delivered through either eligible community housing providers, public housing, and a qualifying build-to-rent development. So they've expanded that pool of properties that are able to negatively on existing properties even wider.
Yeah. And of course, as we say, because the changes come into effect
1
from
July
1st July next year. So we kind of needed to know this detail pretty quickly. And of course, so many people now reviewing their strategies and being like, what do I do next? Which has probably caused some of the mortgage demand loss. Has been like a lot of people just not sure where they sit and kind of being like, well, what do I do? I need to talk to my accountant, I need to talk to my financial planner. If you've talked to any accountants recently, you know they are fully booked for weeks.
Yeah.
Trying to get an appointment with your accountant at the moment, impossible. And so I think a lot of this mortgage demand might also be from people just being like, I don't yet know what my strategy is. I don't yet know what my position is. I don't yet know what my portfolio looks like. So I need to talk to my accountant first before I can move forward. So.
The draft changes also dealt with it put forward this. I was talking about it with a colleague of mine that works for the accounting titles. It's really interesting because the draft exposure legislation put forward this formula for individuals to use on valuations, factoring in the pre 50% CGT discount and then the post minimum 30% plus indexation. But it's like 22 steps. Like it's even the...
No one said tax is easy.
No, 100% not. But yeah, you're just going to see this massive spike in demand for professionals and accountants and valuations and these kind of things as people reassess their options. So I think the government's trying to make people's lives easier.
Yeah, the valuations will be interesting. Lots of people saying, well, will people just kind of be going, go on, like say it's a slightly different value than what you think it is?
Hopefully not. Hopefully that's not the case. But yeah, I think as we were talking about before, these are massive changes, and as more reporting is done and kind of more examination is done by tax professionals and whatnot, I think more things are gonna eventuate and reveal themselves as time goes on. Hopefully, there's not too many of those.
It's a 2-week consultation now.
Yes,
Do
it's
they
pretty short.
expect any more changes, or? Is this
Well,
gonna be
I guess
it,
we have
or-
to see what the consultation says, but I think the idea is they'll do the consultation for, I can't remember the date, is it 17th of August?
Well, it's 2 weeks from when they announced it, so yeah, whatever that is.
Mid-August.
Yeah.
So you've got a couple of weeks, and then I think then they go through and kind of go, this is what we're going to do, but I don't think they consult again after that.
Okay. Yep.
I think this is the end of that stage.
Yes.
Or hopefully it's the end
Hopefully,
of.
fingers crossed.
But yeah, there was a lot of kickback about that 2-week process as well.
Yeah. We'll take a quick break here. When we come back, we'll talk about some of the financial complaints we've been seeing and what people are complaining about, what sort of problems they've been having with the financial services and broader banking industry. And we'll get into that just after this. So this week we had some updates from the Australian Financial Complaints Authority, otherwise known as AFCA, which is obviously looking at financial complaints. And this is always an interesting data set because they kind of release it in 2 stages. So you get the overview of what exactly over the year people are complaining about, but then you get to play with the data in the data cube, which is where we get much more detail. We can actually look at where specifically people are complaining about with brokers and which brokers and who they aggregate through. That whole thing is really interesting, but that's not yet available. But we do have an overarching look at how many complaints and what kind of complaints we were getting over FY26. Big one, as always, banking.
Yeah, no good.
That's the headline. There we go. That's all you need to know.
Yeah, well, like as it sort of said in the story, it's the highest annual tally since the scheme began. In third consecutive year, complaints have exceeded 100,000 complaints, and banking and finance remain the largest complaint category at 66,971 cases.
That's a lot.
That is the lion's share, and it is up 23% from the previous year. So,
and I think whenever we get a rising rate cycle, we do see a spike in complaints because obviously people are more stressed and they're more under pressure, and they're suddenly having to, maybe if they are starting to reach hardship, they're realizing that maybe their contract wasn't what they thought it was, or maybe their bank wasn't quite doing what they thought they were going to, and so having complaints that way. But I always think it's interesting. We do always see banking and finance pretty much among the top areas, as well as financial planning, which again has had a huge amount of complaints this year.
Percentages spiked in that category. It's like 50%.
Up 50%.
Oh, really?
And again,
Yeah.
this is still the fallout from some of those big collapses we saw over the last couple of years. So it's kind of people realizing what's happening and complaining about it. Charlie, for you in the banking and finance space, what were the big things that people were complaining about specifically?
So the 3 most complained about items were personal transaction accounts, motor vehicle insurance, and credit cards, which all saw spikes. But yeah, AFCA's kind of stressing, as you were talking about before, as we enter these periods of, increased strain with rates rising and cost of living is still ongoing, these risk of arrears and defaults are up, you're going to naturally see an increase in complaints. And AFCA obviously addressing that, 3 years of consecutive above 100,000 complaints kind of underscores how much pressure people are actually under. And it's reflected in the numbers, and AFCA saying that these ongoing cost of living challenges are really having an impact on their complaint volumes and caseloads. But also there's other factors at play as well, like we were talking about in kind of financial advice. AFCA specifically outlined the collapse of those, firms.
Shield,
yeah,
Shield and Guardian, First Guardian, Shield. Yeah.
Yes, as having a direct causal impact on financial complaints in that category as well. But also, like we were talking about earlier, but early engagement is up as well. So people, engaging earlier with AFCA is also up. So kind of before it enters the dispute process and that kind of thing, the remediation process kind of internally before it kind of officially lodges has also increased. So people are getting more savvy and proactive, but also I think just want to have achievable outcomes.
It's an interesting process, the AFCA process. When they first launched, we wrote a series of features in the Advisor about how it actually works and what actually takes place and how they review complaints. And very, very few of them go all the way through to final tribunal where they actually have to make a judgment. A lot of them get settled in the first stage where they're just reviewing and kind of mediating between the complaint and the company.
Yeah.
Then there might be a few more that kind of get settled further down the track, where a lot of the time people just end up paying some sort of compensation to the complainant.
Yeah.
But most of them are kind of resolved. So you see very, very few go all the way through to the final kind of tribunal area.
Yeah. Well, that specifically is way up. Disputes being resolved earliest on in the process is 43% up. Complaints being finalised before reaching the Ombudsman formal decision process.
Yeah.
So, I don't know.
They're closing them early.
Yeah, it's kind of when you've got that many complaints, ideally you probably don't want all of them to flow through to the kind of final step.
You'd hope so. And I think it comes down to having a good, kind of resolution process and having a good complaints process.
Yeah.
Again, we repeatedly say whenever we look at the AFCA complaints in the data cube, very, very few in the broker channel. I think it's usually less than 40 in the whole of the broker channel. So something like 0.1% of all complaints are broker.
Pretty good.
Fingers crossed it's still the same this year when we see that final data. But generally, I think, people don't tend to complain to their broker. Firstly, a lot of them aren't paying their broker, so it's not really a problem. Also, the contract that they're going into isn't with the broker, it's with the lender. So if they have a problem with the contract, it's usually because of the lender.
Yeah.
So it's not really they're complaining about massively what a broker is doing, because so many people, I think, value what their broker is doing for them, often at no cost to them.
No.
So I think that's an interesting area. Whenever we look at complaints, of course, the next question is about levies and looking at, how much does this cost? And we know that AFCA and ASIC and APRA and the CSLR all have levies for the industry when it comes to the privilege of being regulated by them and having to deal with them. But lots of interesting stats coming out from AFCA. So if you haven't read that story, I'd encourage you to go and have a look at it. And obviously keep an eye out for the next set when we get the data cube information too, and we can look at what the broker channel is doing.
Delve into the detail. They're just laying the ground first.
Yeah. Yep. Next week, we've got the RBA decision for August on the 11th of August. So they'll be meeting next Monday and Tuesday. So next week when we do our What's Big Headlines, I'm sure we'll be unpacking what the RBA has done.
Yeah.
Crystal ball from you both. What do you think they're going to do?
You first, Ben.
Oh, no. No, I think everyone's sort of pressing a hold at the moment, I think.
And do you think that?
I think based on everything I've sort of read and heard in the market, that makes most sense. Based on what the RBA sort of said as well. Who knows what could happen between then and now, though.
Charlie, hold a rise, hike, or a drop?
I think it'll be a hold. They've gone up 3 times consecutively and they held at their last meeting. So a lot of the banks and analysts think that, monetary policy is tight enough for the time being. It's at a ideal spot, given how much uncertainty is floating around at the moment. And the data's at this stage going in the RBA's favour, more or less, with kind of employment, not really, but inflation.
Spending.
But that's tempered from where it was. And I saw a lot of the major bank analysis stating that, it's come down more than the RBA was initially forecasting at the beginning of the rate hiking cycle. So it is tempering spending, but it's still growing. People are still out there spending, and it's winter as well, when it's usually more subdued.
Well, sort of, yes, because we always see that spike in people traveling to Europe for summer, for European summer. So you do get the cost of flights always increase, and also the cost generally of sort of flight and transport has increased as the war in Iran has continued on. So kind of looking at oil prices increasing the cost. But yeah, I think generally, when we were looking at spending, it was mostly travel. Yeah. And can't remember what the first one was. Travel was the second one.
I think rents are quite up there as well.
No, this is discretionary.
There's a lot of recreational spending still is holding quite firm, like eating out and concerts and retail is still quite sturdy, which is, I think, what the RBA looks at as well. If people have got enough money, they think, to splurge on kind of recreational items, an indication of their financial health and I guess how their financial well-being. So if you're spending on some of those recreational items, that's a pretty good indication. But I think it'll be a hold.
Okay.
I don't see a hike. But like I've said to a couple of people this week, I still think it'll be tight in the monetary policy. I think there'll be a vote for a hike. I think one of the members of the board will vote for a hike.
You don't think it'll be unanimous?
No, I don't think it'll be unanimous. I reckon there'll be one or two. So not a line ball, but there'll still be an opposing argument against a hold.
I agree. I think at least one person will say hike. I think they will hold, though. I hope they hold, please.
Yeah, for everyone's sake, we always say this, but I hope they hold as well.
And again, we keep talking about it and saying it's such a blunt lever they pull, because we know that it really only impacts mortgagors, and at the moment, it's not like they're the ones spending loads of money.
No, they're not.
Anyway.
Loads of money on their mortgage.
Loads of money on their mortgage. Bank technically owns it, yes. Spending money on non-discretionary items. When we looking forward, though, we've talked about the RBA decision coming up this month, but also this month we have the Australian Broking Awards. The ABAs next week will be announcing officially the finalists. We have been, over the last couple of weeks, contacting all of the finalists to make sure they're aware, to congratulate them. Before we make the formal announcement. So that will be coming up next week. And then we have the Australian Broking Awards on Friday, the 28th of August. It will be taking place at the Hyatt Regency this year, not the Star. So make sure you go to the Hyatt Regency if you're a regular attendant of the Australian Broking Awards. And it's a daytime event as well. So we really enjoy having a luncheon event where we get to celebrate the national winners of the broking industry, mostly covering off mortgage and finance broking. Doesn't really have any lender awards in the ABAs. It's a broker activity. And this year we'll be doing something a little bit exciting. We'll be bringing back the Brightest Broker, Broker IQ, the big quiz that we are doing to find Australia's brightest broker. And you'll be getting information about that, I think, next week. Pretty soon we'll be releasing what exactly that entails and how you can be crowned Australia's brightest broker. So keep an eye out for that. It'll be coming through in your emails from me. But yeah, and then following that, lots more coming on down the tracks with the news. Make sure you're subscribed to theadvisor.com.au, either as a free subscriber or if you read more than 5 stories a month as a premium subscriber. There's heaps of news that we are keeping you busy with and informed with. So do make sure you check that all out. Otherwise, we'll catch you next time for an episode on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.